While most people were sleeping, gold quietly shattered another all-time high. And if you think you've missed the boat, you're about to discover why this might be the last boarding call before something unprecedented happens in the precious metals market. Right now, there's a silent war happening in the gold market that most investors don't even know exists. Central banks around the world are hoarding gold at a pace we haven't seen in over half a century. They're not just buying a little here and there, they're accumulating at what the World Gold Council calls an eye-watering pace. In fact, gold hit 40 new record highs this year alone. 40. That's not a bull market. That's a systematic repricing of what gold means in the global financial system. But here's what's really fascinating. This isn't being driven by retail investors panicking or some temporary crisis. This is institutional money, smart money, the kind of money that moves markets and shapes economies. Central banks, sovereign wealth funds, pension managers, they're all moving in the same direction, and they're doing it quietly, methodically, and with a sense of urgency that should make every investor pay attention. Let me paint you a picture of what's actually happening behind the scenes. When you look at the gold market, most people see the price on their screen and think that's the whole story. But the real story is in the mechanics of how gold trades, who's buying it, and why they're buying it now. The London Bullion Market Association, the LBMA, is where most of the world's gold changes hands. It's not a flashy exchange with bells and whistles. It's a network of banks and dealers moving massive quantities of physical gold between vaults. And right now, something unusual is happening in those vaults. Physical gold is being withdrawn at rates that suggest someone knows something the general public doesn't. At the same time, over in New York, the COMEX futures market tells a different story. This is where paper gold trades. Contracts that represent gold, but aren't actually backed by physical metal in most cases. For decades, the COMEX has been the tail wagging the dog, with paper contracts setting the price for physical gold. But that relationship is starting to break down. We're seeing moments where physical gold commands a premium over paper gold. That's not supposed to happen in a functioning market. It's a sign of stress, a sign that the people who actually want to hold gold in their hands don't trust the paper promises anymore. Think about what that means. For years, the financial system has operated on the assumption that paper claims on gold are just as good as the real thing. Banks could sell contracts for gold they didn't have, knowing that most people would just settle in cash rather than demand delivery. It's a system built on leverage and trust. But when that trust starts to crack, when people start demanding physical delivery, the whole structure becomes unstable. And that's exactly what we're seeing now. Central banks aren't buying paper gold. They're buying physical bars and moving them into their own vaults. They're repatriating gold that was stored in other countries. Germany spent years quietly moving hundreds of tons of gold from New York and Paris back to Frankfurt. The Netherlands did the same thing. Austria, too. These aren't small moves. These are strategic decisions that signal a fundamental shift in how these institutions view risk and trust in the global financial system. Why would they do this? Why now? To understand that, you need to understand what's happening to the US dollar. For over 50 years since Nixon closed the gold window in 1971, the dollar has been the world's reserve currency backed by nothing but faith and the full credit of the US government. That system has worked remarkably well for America. We've been able to print money, run massive deficits, and export our inflation to the rest of the world because everyone needed dollars to buy oil, to trade internationally, to hold as reserves. But that system is under stress like never before. The BRICS nations, Brazil, Russia, India, China, and South Africa, along with dozens of other countries that want to join, are actively working to create alternatives to the dollar. They're settling trade in their own currencies. They're building payment systems that bypass SWIFT. And most importantly, they're accumulating gold as a neutral reserve asset that doesn't depend on any single country's monetary policy. China is particularly interesting in this regard. For years, China reported modest gold purchases to the International Monetary Fund. A few tons here, a few tons there. But analysts who track gold flows believe China has been accumulating far more than they officially report. Some estimates put China's actual gold reserves at several times what they publicly acknowledge. Why would they hide it? Because if the market knew how much gold China was really buying, the price would skyrocket before they finished accumulating. Russia took a different approach. After being hit with sanctions, Russia went on a gold buying spree, more than doubling their reserves in just a few years. They made it clear that gold was their hedge against Western financial pressure. And it worked. When sanctions cut Russia off from dollar markets, they had gold to fall back on. Other countries watched and learned. This is the context that makes the current gold rally so significant. This isn't speculation. This isn't momentum trading. This is a fundamental repricing based on structural changes in the global monetary system. When gold was at $1,200 an ounce just a few years ago, people said it was dead, a relic. Bitcoin was the new gold, they said. Digital assets were the future. But here we are with gold at $4,400 and climbing, while many of those digital assets have proven to be far more volatile and far less reliable as stores of value. Now, let me address something important for those of you thinking about your retirement security. If you're sitting on $100,000 or more in traditional retirement accounts, there's a strategy worth understanding. Gold IRAs allow you to hold physical precious metals in a tax-advantaged retirement account. I've put together a comprehensive guide on how this works, the rules you need to know, and how to do it without triggering tax penalties. You'll find that in the description below. It's worth reviewing if wealth preservation is part of your retirement strategy. But let's get back to where this market is headed, because the technical picture is just as compelling as the fundamentals. When you look at gold's chart over the past few years, you see a pattern of higher lows and higher highs. Each pullback has been shallower than the last. Each breakout has been stronger. This is what accumulation looks like. This is what happens when large institutions are systematically building positions. The breakout above $4,400 is particularly significant because it takes gold into uncharted territory with no overhead resistance. There are no sellers waiting at higher prices because we've never been at these prices before. The only thing that can stop this rally is either a fundamental change in the factors driving it or a massive increase in supply. And neither of those things is likely to happen anytime soon. On the supply side, gold mining is actually getting harder, not easier. The easy gold has been found. New discoveries are rare and expensive to develop. It takes years to bring a new mine online, and production from existing mines is declining in many cases. Meanwhile, demand from central banks, jewelry, technology, and investment continues to grow. That's a recipe for higher prices. But there's another factor that most people aren't considering. The gold market is relatively small compared to other asset markets. The entire above-ground stock of gold is worth maybe $15 trillion at current prices. That sounds like a lot until you compare it to global stock markets at over $100 trillion, or bond markets at over $130 trillion, or real estate in the hundreds of trillions. If even a small percentage of money from those larger markets flows into gold, the price impact would be enormous. And that flow is starting to happen. We're seeing it in the ETF data. Gold-backed exchange-traded funds saw massive inflows this year. These are investment vehicles that hold physical gold and issue shares against it. When money flows into these ETFs, they have to buy physical gold to back the new shares. That creates real demand in the physical market. But here's where it gets really interesting. The ETF buying is nothing compared to what central banks are doing. Central banks bought over 1,000 tons of gold last year. That's roughly 10% of annual mine production. They're doing it again this year. At some point, this level of buying creates a supply squeeze. There's only so much gold available, and when the biggest buyers in the market are taking physical delivery and locking it away in vaults, that gold comes off the market permanently. This is why some analysts are talking about a potential short squeeze in the gold market. Not a short squeeze in the traditional sense, where traders who bet against the price are forced to cover, but a physical squeeze, where the demand for actual metal exceeds the available supply, forcing paper gold holders to settle in cash because there isn't enough physical gold to deliver. If that happens, we could see gold gap up hundreds of dollars in a single day. We could see premiums for physical gold over paper gold explode. We could see a complete breakdown in the pricing mechanism that has governed the gold market for decades. It would be chaotic, but it would also be incredibly profitable for anyone holding physical gold or gold mining shares. The mining shares are particularly interesting right now because they're not keeping pace with the gold price. Historically, gold miners are leveraged plays on the gold price. When gold goes up 10%, mining shares might go up 20% or 30% because their profit margins expand dramatically. But right now, many mining shares are trading at valuations that suggest gold at $3,000 or $3,500, not $4,400. That disconnect won't last forever. Either gold comes down, which seems unlikely given the fundamental drivers, or mining shares catch up in a violent move higher. Let me give you some historical context for what we're seeing. In 1971, when Nixon closed the gold window and ended the dollar's convertibility to gold, gold was $35 an ounce. Over the next 9 years, it went to $850. That's a 24-fold increase. It wasn't a straight line. There were pullbacks, consolidations, moments of doubt, but the overall trend was unmistakable because the fundamental driver, the loss of confidence in fiat currency, was powerful and persistent. In 1980, gold peaked and then entered a 20-year bear market. It bottomed around $250 in 1999. People declared gold dead. Central banks were selling their reserves. The Bank of England famously sold half of Britain's gold at the bottom, a decision that cost the country billions and is still called Brown's Bottom after the chancellor who ordered it. But then something changed. In 2001, gold started climbing again. Slowly at first, then faster. By 2008, when the financial crisis hit, gold was over $1,000. By 2011, it peaked at $1,900. Then it pulled back again, consolidating for years, testing the patience of gold bulls who thought the big move was over. But it wasn't over. It was just resting, building energy for the next leg. And that next leg started in 2019, accelerated through the pandemic, and is now breaking out to new highs with conviction. The difference between now and 2011 is that the fundamental drivers are stronger, the debt levels are higher, the monetary expansion is larger, the geopolitical tensions are more severe, and most importantly, central banks are buying instead of selling. This is the setup that has some of the smartest analysts in the precious metal space talking about gold at $5,000, $6,000, even $10,000 an ounce. Those numbers sound crazy until you adjust for inflation and realize that gold would need to hit $3,500 just to match its 1980 peak in real terms. We're already past that, so in inflation-adjusted terms, we're in new territory, but not by much. There's plenty of room to run. Silver is an even more interesting story, though we're focused on gold today. Silver hit record highs recently, driven by the same factors as gold, but with additional demand from industrial applications, particularly in solar panels and electric vehicles. Silver is both a monetary metal and an industrial metal, which gives it unique characteristics. But that's a topic for another discussion. What you need to understand right now is that we're at an inflection point. The gold market is sending a signal that something fundamental has changed in the global financial system. Central banks see it. Sovereign wealth funds see it. Large institutional investors see it. The question is whether individual investors will see it in time to position themselves before the next leg higher. Because here's the thing about these major moves in gold. They don't happen gradually. They happen in bursts. Gold will consolidate for months or even years, grinding higher slowly, testing support, building a base, and then suddenly, in a matter of weeks or even days, it will gap up hundreds of dollars as a wave of buying overwhelms the market. If you're not positioned before those moves happen, you miss them. And trying to chase gold after it's already moved is a recipe for buying at temporary tops. The smart money is positioning now. They're not waiting for confirmation. They're not waiting for gold to hit $5,000 to prove the trend is real. They're buying at $4,400 because they understand that $4,400 will look cheap when gold is at $6,000. Just like $2,000 looked expensive to many people a couple years ago, but now looks like an incredible entry point in hindsight. This is how wealth is built in markets. Not by chasing what's already moved, but by identifying structural trends early and having the conviction to stay with them through the volatility. Gold is volatile. It will have pullbacks. There will be days or weeks where it drops $100 or $200 and the headlines scream that the rally is over. But if the fundamental drivers remain in place, those pullbacks are buying opportunities, not reasons to panic. And the fundamental drivers are absolutely in place. We have unprecedented levels of government debt across the developed world. We have central banks that have proven they will print unlimited amounts of money to support financial markets and economies. We have geopolitical tensions that show no signs of easing. We have a global monetary system in transition, with the dollar's dominance being challenged for the first time in generations. And we have central banks voting with their wallets, buying gold at record pace because they see what's coming. This isn't fear-mongering. This isn't doom and gloom. This is simply reading the signals that the market is sending. Gold doesn't lie. It doesn't have a political agenda. It doesn't care about narratives or spin. It simply reflects the collective judgment of millions of market participants about the value of fiat currencies and the stability of the financial system. And right now, that judgment is clear. Gold is going higher because the alternatives are becoming less attractive. Think about what it means that gold is at all-time highs while stock markets are also near all-time highs. Usually, gold and stocks move in opposite directions. Gold rallies when people are scared and fleeing to safety. Stocks rally when people are optimistic and taking risk. But right now, both are rallying together. That tells you that there's so much money being created, so much liquidity sloshing around the system, that it's lifting all asset prices. But it also tells you that smart investors are hedging. They're staying in stocks for the upside, but they're buying gold as insurance against the downside. That's actually a very rational strategy in the current environment. You don't have to choose between stocks and gold. You can own both. In fact, you probably should own both. But the key is to have meaningful exposure to gold, not just a token position. If gold is 2% or 3% of your portfolio, it's not going to move the needle even if it doubles. But if gold is 10% or 15% or 20% of your portfolio, and it goes from $4,400 to $6,000 or $8,000, that's a significant impact on your overall wealth. The other thing to consider is the form in which you hold gold. Physical gold, coins and bars, gives you direct ownership with no counterparty risk, but it requires secure storage and isn't very liquid. Gold ETFs are convenient and liquid, but you're trusting the fund manager and the custodian. Gold mining shares give you leverage to the gold price, but they come with company-specific risks. There's no perfect answer. The right approach depends on your situation, your risk tolerance, and your goals. What's not debatable is that gold deserves a place in a well-constructed portfolio right now. The evidence is overwhelming. The trend is clear. The fundamentals are supportive. And the technical picture shows strength and momentum. This is the kind of setup that comes along maybe once or twice in a generation. The last time we had a setup this compelling was in the early 2000s, when gold was breaking out from its 20-year bear market. The people who recognized that trend early and stayed with it made fortunes. The people who waited for confirmation or tried to time the perfect entry missed most of the move. We're at a similar juncture now. Gold has broken out. It's making new highs. The drivers are in place for much higher prices. The question is whether you're going to act on this information, or whether you're going to watch from the sidelines and wish you had positioned yourself when you had the chance. Because here's the reality. When gold is at $6,000 or $8,000 or $10,000, people will look back at $4,400 and wonder why they didn't buy. They'll have all kinds of reasons. It seemed too high. They were waiting for a pullback. They didn't believe the rally would continue. But those reasons won't change the fact that they missed the opportunity. The train is leaving the station. The doors are still open. But they won't stay open forever. At some point, gold will gap up in a way that makes current prices look like a distant memory. At some point, the physical shortage will become acute enough that premiums explode and availability becomes an issue. At some point, the momentum will be so obvious that everyone will want in, and that's when it becomes hard to get positioned at reasonable prices. This is your moment. This is your chance to get ahead of the crowd instead of following it, to position yourself based on fundamentals and logic instead of emotion and headlines, to take advantage of a structural trend that has years left to run instead of trying to catch the last 10% of a move that's already exhausted. The gold market is telling you something. Central banks are telling you something. The price action is telling you something. The question is whether you're listening, whether you're willing to act on information that contradicts the mainstream narrative, whether you have the conviction to buy an asset that's already at all-time highs because you understand that all-time highs are just the beginning when the fundamental drivers are this powerful. Gold is leaving the station. This is your last call. All aboard.